You're probably wondering, how does Warren Buffett pick his stocks? How does he and Charlie Munger identify companies to invest in for Berkshire Hathaway? In this video, I'm going to run through the 4 investment criteria that Buffett follows in order to identify companies to invest in. These 4 criteria have changed over time, but they are very much the same from when he first wrote about them back in 1977. The 4 criteria that Warren Buffett uses to pick stocks include investing in companies with favorable long-term prospects, investments that he can buy at an attractive or sensible price, where he can invest in companies which have management that are deemed to be competent and have strong reputations. And also, he wants to invest in businesses and only in businesses that he can understand, that is, within his circle of competence. We're going to talk now about each of these 4 things and what you can do as an investor to identify these 4 criteria as you go about your investing. The first thing that Warren Buffett looks for is companies that fit within his circle of competence. Imagine a circle, and within that you have a smaller circle that identifies what you do or don't know. And so this is not about you necessarily investing in everything in the market or even just going into really technical things, but it's about understanding the companies or industries that you might have a better than average chance of identifying good long-term investments. For example, within your circle of competence, you might have the things that are around you here and now, the phones that you have in your hand, the tools or services that you use from different companies every single day. Maybe you go to the supermarket and you experience things there. You may understand that product better than someone else. And that is one of the things that you can use to your advantage. Other things that you might use include your occupation. Where you work might actually throw up some really interesting investment ideas. For example, you might be a mechanic who understands different makes and models of cars. You might understand them better than I do, and that is an advantage for you. Finally, you might also have some sort of academic experience or some sort of learned experience. So for example, if you have studied in a particular field, maybe you're an engineer and you can understand infrastructure companies, or maybe you can understand aerospace companies. You should use all of these skills to your advantage to identify what it is that you want to invest in and what you're good at. Remember, you can expand your circle of competence over time. Over many years, Warren and Charlie Munger have talked about how to expand your circle of competence and understand the world better. This includes building a lattice work of mental models, according to Charlie Munger, where you learn things from different industries, the important things from each industry, and then you relate that back to other parts of your life or other parts of your investing. So that is knowing your circle of competence and sticking with that. Personally, I choose to invest in technology companies and companies involved in software because my background is in startups and technology. I also studied technology at university, so it makes sense for me to focus on those areas of the market to find opportunities to invest in. Warren Buffett has often talked about companies with favorable long-term prospects. Now, he's not necessarily talking about the next hot trend or sector or thematic. He's not going out investing in companies that could be. He's investing in companies where he understands the business and they have already established their operations. So for example, he invested in Coca-Cola or Apple. When he invested in Apple, the world's biggest smartphone maker, this business was already nearly $1 trillion company, and yet he was investing in the company and still held a stake right through that period. So he wasn't necessarily an early adopter like some investors in the tech sector. Instead, Warren waited for those fundamentals and that competitive advantage to really show through. So what we're looking for here are companies that have really strong fundamentals. So companies that can earn excessive returns against their cost of capital. So what that means is we're looking for companies with high returns on invested capital, or ROIC, and we compare that against the cost of capital, the amount of money that business needs to survive and how much it costs for it to get that capital. Now, there are many different metrics on measuring the moat of a business, but a moat is effectively that ring of water that goes around a castle, and it relates to companies in a few simple ways. The moat around the castle protects what the castle is, i.e. the franchise. So in an investing context, the moat is kind of what makes a business defensible. And that is what creates its competitive advantage. You're looking for companies that can charge higher prices than competitors, have strong brands, I have that presence of mind when someone thinks, oh, I want to get some chocolate or some candy, maybe I'll go to C's Candy. These are the types of things that Warren is looking for. He's looking for very strong businesses and very strong protections around the outside, because that is what creates favorable long-term prospects, the ability to be defensible. Warren often talks about having only 20 investment decisions that you could make in your lifetime. If you had only 20, you would make some really good decisions. And typically, you would focus on companies that will still be around many years into the future. Warren has 2 rules for investing. Don't lose money. And rule number 2 is don't forget rule number 1. It's very simple criteria. And if you think about that in the context of a business and identifying very strong and resilient businesses, they're looking for companies with durable competitive advantages to create long-term prospects that are favorable. Number 3, Warren Buffett has often talked about finding companies with honest and competent people. Now, you can probably think of 3 different ways to measure a management team. You can find management teams with energy, integrity, and talent. And typically, you don't want lots of energy and lots of talent and no integrity. It needs to be a measure of all 3. And Warren is out there with Charlie looking for companies which have CEOs and management teams that are aligned. So have these CEOs and management teams invested in the companies that they run? Do they think for the long term, not for the short term bonuses? Are they aligned with smaller shareholders? Warren Buffett's wealth is tied up in Berkshire Hathaway, which you and I could invest in. And by doing so, we know that Warren is going to take care of our investment because he is aligned, because his wealth is also tied to it. So we're looking for companies that have management teams that have that alignment to build that integrity. They're also candid and honest. They speak about the important things, the successes and the failures with their shareholders. Those are some really important traits of management teams with integrity. Obviously, when it comes to talent, we can measure that through historical performance of CEOs and boards of directors and also the executive teams. Have they done what they said? Have they proven themselves to shareholders? It's a very simple set of ideals. Finally, and this one's one of my own per se, which is on the energy piece. When we're looking for management teams with energy, what we're typically looking for are founders or family-run businesses. Now, that's not always the case, but we want our management teams to think that way because we want their decision-making to go beyond the quarterly profits or the half-yearly profits or even the annual profits. We're looking for management teams that, kind of wear their company's logo with pride. And they say, I want this business to succeed for the long term. I want to pass this on to the next CEO or the next generation and have this business running for decades to come. Management is very, very important. Pat Dorsey, who is another respected investor, says it's like finding the jockey to ride the horse. You want a great jockey on a great horse. This is the one of Warren Buffett's criteria where we're focusing on the jockey, picking the right jockey for the right horse. That is really important, and it's obvious why it is one of the 4 criteria that Warren Buffett focuses on. Warren has often talked about finding companies with attractive prices, so finding stocks to buy that are trading at attractive valuations. In the past, he would remark about very attractive valuations. Now, it's more about sensible valuations. The way I've interpreted his 4th criteria, which is on valuation, is more about being, reasonable with the valuation. So instead of doing a discounted cash flow analysis or running really in-depth modeling on certain things, Warren might use simple techniques to value a company, such as focusing on operator earnings or the true earnings of a business. And this is about finding the company's sustainable earnings and then making a valuation around that. Of course, many investors who have followed in Warren Buffett's footsteps use things like discounted cash flow analysis or DCF. Other investors have used more simple heuristics like multiples of sales or multiples of profit or earnings. These are all respected valuation techniques, but the important point is actually just having some sort of reasonable basis to have informed your valuation decision. Remember that valuations also change through time. Because Warren is seeking excellent or wonderful businesses, he's actually hoping that the value of the businesses increase through time, not necessarily just the stock price. Imagine the stock market closed for 5 years. Would you be happy owning this business? If you take that very simple idea and you put it into practice with your valuation, typically what you might be looking for are businesses that you are very, very confident in will still be around in 5 years. Not necessarily the cheapest stock at the time, but focusing on companies that will still be around in 5 years and then using some type of technique to get to that. You could use, again, discounted cash flow analysis. Charlie Munger has talked in the past about using discounted cash flow analysis and maybe how they go wrong, but you could use a discounted cash flow analysis and discount at the cash rate, as in what is the future value of this company's earnings or profit in today's dollars, discounted back at a very low rate or a very reasonable rate. Now, there are some investors in the industry who would disagree with that and say you need to use a higher discount rate to get those earnings back to today. The important point is basically focusing on this concept of operator earnings or owner earnings, which is in modern times is more referred to as free cash flow. So what is this business producing in terms of its free cash flow, and let's create a valuation on top of that. There are many more resources on this valuation piece on our YouTube channel. So those are the 4 techniques that Warren Buffett and Charlie Munger use to select stocks. We've got management teams who are competent. We have favorable long-term prospects. We have a circle of competence which guides our investing, and of course, valuation. There are 4 techniques, and I dare say that they will all be expanded on in time, and there are many quotes to match each of these criteria. It's a very similar criteria to what I use to invest. I might throw an extra 1 or 2 in there though. Thanks for watching this video. To find more valuation videos or investment videos, head to the Rask YouTube channel or find us at Rask Education. Thanks for watching.